Thank you for your company for this week's wrap. My name's Jessica Amir. I'm a market analyst with Bell Direct. Well, the Australian share market has extended its winning streak, rising for the fourth straight week. And so far this month, the benchmark ASX 200 is up 6.7%. That's the best monthly gain since July of 2009. We're still technically in a bear market, down 24% from our all-time high that we hit in February. But over the past 24 days, which you can see the line on the right-hand side, the market has risen 20% through to Thursday. And that means that we're technically in a bull market. And this month, all sectors pushed ahead, the most charged from energy, IT, real estate and materials, all rising 10 to 14%. On the other side of the market, financials have been the underperformer as they're closely linked to the economic cycle. In terms of outperforming stocks with the most momentum, NRW up 47%, Afterpay up 45%, Parenti up 43%. Now on the flip side, you can see WiseTech is down the most, down 10%, Harvey Norman down 7%, Fisher & Paykel losing 6%. So where to from here? Well, we know markets are forward-looking, so they've priced in that we're going to have our first recession in 29 years and that the unemployment rate is tipped to be double digits. And consensus also suggests that market earnings per share will drop 4% this year and is not likely to recover next year. But for Citi, they say if you use 2007 as an example, you could expect the market to get back above those pre-crisis levels once EPS recovers. So for now, this year, they're expecting earnings per share to drop 10% this year and to drop by 16% next year. Citi also says keep an eye out for software services, packaging businesses, staples, metals and minings, as these sectors perform the best following the GFC, while real estate, engineering, diversified financials, consumer services and transportation perform the worst after the GFC. But keep in mind, Citi is more positive about banks and retailers given the economic downturn that we're experiencing is different to the GFC. We also know some businesses are walking away from their forecasts as 70 to 80% of Australian businesses, according to the recent ABS survey, have said that they're severely hampered by coronavirus, while some businesses are thriving, seeing sales rise and they're having to put on staff to keep up, like Telstra, Woolworths and Priceline owner API. Now for Morningstar, they're expecting telcos to shine the brightest given their balance sheets are strong enough to weather the coronavirus storm. The research house says Telstra should emerge stronger than ever and it's likely to grow its market share amid increased demand, and it's bringing forward that $500 million of capital to increase capacity and also ramp up the rollout of its 5G network. It's also hiring 1,000 people across their call centres. Now, aside from Telstra, Morningstar also likes Vocus and TPG. Now, to the other changes that have taken place this week, Goldman Sachs downgraded Afterpay from a buy to a hold after Afterpay rose 40% this month. And Goldman's noted Afterpay appears to have diverged away from its competitors in the Australian and New Zealand landscape, while Goldman Sachs upgraded Afterpay's earnings and revenue, but gave Afterpay stock a price target of $25.75, implying it will fall. Now, Bell Potter reiterated Afterpay as a buy with a price target this week, a 12-month price target of $45.95, favouring the company as its cash position increased to $541 million, and it's also focusing on low-risk customers. That being said, Bell Potter doesn't expect its underlying customer growth to be positive forever. Now, looking at other Bell Potter recommendations, Appen APX, the artificial intelligence company behind Siri, and some of the world's biggest tech companies, well, they maintain their earnings guidance, their 2020 earnings guidance, and Bell Potter expects more upside to come out of this company from pandemic-led growth in search engines, social media, and e-commerce platforms. But downside risk for Appen could come in way of some of their smaller clients potentially cancelling services. But Bell Potter expects Appen's net profit after tax to grow to $83 million this year, and they look forward to their AGM in May, and they've increased their earnings per share by 1%. And giving it a price target of $27.50, implying 15% share price growth. And if you look for stocks now, more stocks that are growing their earnings and shareholder growth, and particularly in the long-term growing market, Bell Potter's champion stock picks include Amcor, which is backed by Morningstar, Transurban, Lendlease, Goodman, Netwealth, CSL, Sonic and Brambles. Now looking at UBS, we know Star Entertainment boosted its liquidity, pushed back its dividend, and also had its gearing and interest waived until July. And they've also lodged an insurance claim to offset against the business being shut down. But UBS has modelled for a possible worst case scenario, and if the casino is shut for the rest of this year, it would still have $200 million left. Which is why UBS reiterated Star as a buy with $3 price target. And following Bapcor's announcement to raise $180 million, it was reiterated as a UBS buy, particularly given revenues are down but margins are steady. Now, lastly, looking at what to watch next week in terms of economic data. Of course, we get those two new economic pulse checks from the ABS in terms of weekly jobs data out on Monday and Tuesday, and then on the same day, the RBA on Tuesday will release their meeting minutes, and on Friday, CPI and inflation is out. So there's plenty to consider and plenty of stock ideas for your portfolio for 2020. I'm Jessica Amir from Bell Direct. Happy trading. Stay safe.